Hello, this is Doug Gerlach, the editor-in-chief and founder of the Small Cap Informer stock newsletter. Welcome to our 2022 Outlook webinar, an exclusive for subscribers of the newsletter. Today is January 5th, 2022, so we're just a couple of days into the brand new year. And in the next hour or so, we're going to take a look at the performance of the broader market and the small cap segment in 2021. We're going to take a look at what might be ahead in 2022, the pitfalls and highlights that we might expect as investors in the stock market. We'll take a look at the economic climate, and then we'll wrap it up with a discussion of our top stock picks for the past year, as well as the introduction of our top small cap picks for 2022, our annual tradition, where we spotlight those companies that we think have a little extra promise perhaps in the coming year. So thank you all for being with us for yet another year as Small Cap Informer subscribers. And now you will notice the handouts tab where you can find the handout, the slides of today's presentation, as well as the top small cap stocks 2022 special report, which you can download. And you can also find that on the Small Cap Informer website. With that, Russell Malley, who is our analyst and all-around assistant on the Small Cap Informer, is in the back office as well. But please share your questions and comments in the questions tab. We'll do our best to address as many of them as we can during the presentation. And let's start by taking a look at the market performance in 2021, rather, not 2022, in 2021, and how both the small cap and the large cap and the international segment performed in the past year. This is a graph of the 2001 results for the S&P 500, which is in blue, the S&P Small Cap 600, which is in green, and for comparison's sake, the Europe, Australasia, Far East Index, the EFA Index, in red at the bottom. As you can see, in the first half of the year, small caps really took off, posting big recovery from the 2020 year and leapt out ahead. But the S&P 500 continued its upward trajectory and just straight up and fairly consistently. A little bit of a fallback for both the markets and the market around the world in October due to the discovery of the new COVID variants, but then quick recovery after that for both the small cap and the large cap markets, ending up pretty solid with the S&P 500 up about 27.9% for the year, and the small cap index up about 24% for the year. So strong years for US markets, even though the EFA continues to trail behind a little bit with a 7.4% return. That's been the case for some time now, where the US markets have outperformed the global developed market. When we think about what happened in the year, certainly the recovery from the depths of the economy and the market in 2020 continued through 2021, and that certainly helped small caps, as I mentioned, led through the first half of the year and then paused a little bit. But when you're thinking about the performance of the overall market, it's important to note that the large cap segment was really driven by the outperformance of a handful of mega caps, the very large stocks. And now we've got multiple members at the $3 trillion market cap club, but the recovery from the energy and real estate sectors also contributed to the performance of that large cap. It was not a wide recovery for many larger companies. And when you look at the composition of the S&P 500, 10 stocks make up 30% of the S&P 500, and 25 stocks make up 50% of the S&P 500. So the other 475 stocks make up the bottom half, or the other 50% of the index. So that really puts the emphasis on what's happening with the biggest names, often the technology stocks, the mega caps. And if you look at stocks by price, about 50% of stocks under $20 ended the year down 20% or more from their highs, and 63% of stocks under $10 were down 20% or more. So if you really start dissecting the entire stock market, about 43% of companies were down more than 20% from their highs. And that's the definition of a bear market when it approaches the entire market segment. But to see that 40+% of companies are experiencing their own personal bear markets just gives you a sense of how concentrated the returns were in those large cap, mega cap stocks, the names you know, Microsoft, Apple, Amazon, etc. If you look at the longer term trend, just to keep it in perspective, again, green on top with the small cap 600. This is why we like to include those small company stocks. Going back to 2002, they have well outperformed the S&P 500 and international stocks by and large. So that's why we focus on small cap stocks, and I believe that you should be including small company stocks in your personal portfolio. And my cautionary note, and I'll repeat this probably later in the presentation, is that large caps are showing, the mega caps, we'll say, are showing a large degree of overvaluation right now. So just be cautious with those as we head forward into the year. So let's talk a little more specifically about the stocks that we cover in the small cap informer newsletter and how did they perform in 2021. Well, remember, our objective is not to outperform the broader market, but to keep pace with the S&P small cap 600 index. And that is an index that's selected, so it is an index of 600 companies that S&P selects that represents the smaller segment of the market, unlike the Russell 2000, which is just 2,000 of the smallest 3,000 companies. So we like the S&P small cap 600 as a better representation of the small cap performance. We acknowledge and are upfront that we don't expect to beat the S&P 500 on a regular basis because small caps will perform often in contrary to the performance of the broader market. But as I mentioned, we think that you need to include those smaller companies, and over time that will help your portfolio performance overall. So for the last 1, 3, 5 years and the lifetime, you can see the graph here. The green is the small cap informer compound annualized rate of return for all the covered stocks. So for 2021, our picks were up 34.2% compared to 24.7% benchmark to the S&P small cap 600. Likewise, outperformance for the last 3 years. In the 5 years, the S&P small caps have not performed well in the 5-year period, but our picks have been performing well. And the lifetime since 2012, when the newsletter was started, we're showing an 11.9% annualized rate of return, and compared to 4.2% for the small cap 600 in that period. So we're very pleased with those results. That is our objective. This is the second year, at least, where we've in the 12-year period that we've outperformed of the last 2 years, that we have outperformed the market. But we really focus on that broader, longer term. So I don't pay a special attention to our annual performance if we are over the last 3, 5+ years delivering that consistent rate of return that's higher than the market. Then that is fully in line with my objectives for the newsletter. So we're pleased with that. I hope that you're also pleased with your picks in and the stocks that the Small Cap Informer has helped you to include in your portfolio. Bob has mentioned that his small caps are up 28.44% last year. So we appreciate that feedback and hope to continue. We're going to continue to identify opportunities in the coming months and years ahead. So let's talk about 2022 and what we might expect from the economy as we look ahead from this particular vantage point. Obviously, the pandemic is and remains for the foreseeable future a cause for much concern and careful observation by investors and other market pundits. It's the vaccination rate continues to be less than I think it should be, and there's no doubt that vaccinations have saved hundreds of thousands of lives around the world. The booster deployment, as you know, is underway. The efficacy of the vaccine for the various variants remains under study, and we would expect those to continue to be developed and researched actively as they have been since the pandemic began. Very exciting to hear about the deployment of drugs to treat COVID, the COVID virus especially, and that I think is very good news. That doesn't mean that hospitals are going to see their workload being eased anytime soon. This is just a treatment protocol, so we can decrease the mortality related to the virus, but it still keeps pressure on, and as much as people can do to stay healthy, to stay isolated when they can, to not engage in risky behavior, is better for everyone. Pfizer CEO at the end of last year mentioned the likelihood that the COVID vaccine may become annualized, similar to the influenza vaccine, and that many people already get. So that is one sign of the permanently changed behaviors and practices that I expect the pandemic to create. And there's lots of talk about what the new normal is in terms of the economy and social behavior, but I believe that this is going to be part of it. A little more careful observation of social conditions and get-togethers, etc. So, and you know, it's sort of, it is what it is. No one is saying, I'm not saying let's all stay at home indefinitely, but we're going to be monitoring our behavior, need to monitor on a self-monitoring level the actions that all of us undertake. The medical system continues to remain stressed, with hospitalizations really up with the Omicron variant and the resulting illnesses. The good news is it doesn't appear to be as fatal, but the bad news is that it's putting people into the hospital, and that's keeping people who need to be in the hospital for other reasons under pressure. So hopefully we can continue to benefit from better treatment options. But COVID is a wild card. It's impossible to predict what could happen, especially in the near term. When you look at the market performance last year, you can look at that graph and you can say, oh yeah, here's when Delta was a concern and there was a lot of panic selling in the market. And investors are a little more acclimatized now, and so Omicron is a little easier to brush off, but we should be prepared for much worse. It's always better to be prepared, even if it doesn't come into fruition. So that remains part of what we have to face as investors and as citizens of the world. The supply chain constraints appear to be easing up a little bit, but there's still problems with material scarcity, shipping port congestion, increased freight prices, difficult demand forecasting. Companies just, are really unsure how much they need to be producing, how much they need to be ordering, what demand will be for their products and services going forward. Should they be ordering materials if they can't get all the materials they need, so they've got a stockpile, but then you're sitting on inventory? So we've got all sorts of questions there. Changing consumer attitudes and labor shortages are not helping it. So these are going to continue to plague the economy, I think, in the first half of the year more specifically, but hopefully we'll begin to ease up as we go a little further down the road in 2022. Inflation, of course, is the next big concern. The CPI was running above trend, but then November arrived and the inflation figures were the highest since 1982, and so that got economists into gear, ratcheting up inflation forecasts and throughout the year and beyond. The supply chain issues, the shortages in goods and commodities is pushing prices up as well, and those price pressures are beginning to expand out to categories like housing and energy costs, and so we get into a vicious circle there. The supply chain snarls. The ongoing labor shortages are just making things a little bit worse, and so we're going to expect inflation to get worse before it gets better. And we'll talk about what we can do as investors in the face of increasing inflation. When you look at the University of Michigan's inflation expectation analysis, they do surveys of consumers and economists, and they have you can see this is the expected inflation rate going forward at any point in time. And so you can see it was chugging along through 2017, even into 2018, 2020. 2021, and then has really started ratcheting up to that 4.7, 4.8% range going forward. So everyone is on board, buckled in, expecting prices to increase as we go forward. And that impacts consumer spending and confidence. Confidence is not high, even though people are pretty flush with cash. People have not been traveling as much, so they've been spending on discretionary purchases like home renovations, paying down debt, but that slowed a little bit. Perhaps at the end of the year with the Omicron variant and with a lot of people perhaps wanting to travel, but then finding flights canceled, difficult to get it on a plane. A lot of cruise ships went out at year end and came back with a lot of COVID cases, and so that's impacted that aspect of spending and travel. If you I like to remember what Milton Friedman, who's the Nobel Prize winning economist, discussed in his work, that people spend based on their permanent income, which is their expected long-term average income. They don't splurge when they've got extra cash. The savings rate in the U.S. did increase last year. Government stimulus helped, but people, as they were buckled down at home and were not spending as freely as they have been in the past, and that's likely to continue, especially if prices or the perception that prices are increasing comes along. So the personal consumption expenditures from the U.S. Bureau of Economic Analysis, this is what spending has been like. So dropped off in the pandemic. The gray bar is the official recession period, has been climbing back and is at a back on pace with where it had been in the 3 years prior to 2020, and so that rate of growth there is back on board. Both good, that is good, that is bad. It is what it is. People are spending on personal items, but the sentiment right now is very negative. It obviously took a big nosedive during the onset of the pandemic and the resulting recession. It's been recovering, but now it's at the lowest level it's been since in the last 5 years. So consumers are not very confident in in the economy, and that is not a good sign. But again, it is what it is, and all we can do is kind of wait and see how things pan out. Certainly, the Fed, with its interest rate policy, has shifted from trying to control inflation to perhaps letting inflation grow a bit more expansively. There's a debate about whether inflation is transitory or structural. Is it here to stay? Is it something that will alleviate itself going forward? And so we're just back to where Harry Truman once suggested that he would like to employ a one-armed economist, because that economist would be unable to say, on the other hand, when he was giving advice. But just to give us a picture, a snapshot of where we are right now with the economy and the market as we head into 2022. So let's talk about the market at this point. Valuations, as I mentioned, are pretty rich for the mega caps, for the big companies, and the market has really lifted those and then the broader market along with it well above the long-term trends. And so we expect the market to kind of chug along at a particular rate over time, dips and bobs and weaves here and there, but we've really seen some pretty significant significant increases in stock prices of those big companies. They're perceived as safe. We understand it. They're perceived as solid investments, and they have been going up. So a lot of people look at the market and say, well, gosh, every year for the last couple of years, these stocks are going up in price, so we can just buy them and don't have to worry about it. But a stumble by any of the 30 biggest companies in the S&P 500, in the US economy for that matter, could trigger some widespread declines. And so that is the biggest risk, I think, of a correction. Would start with those largest companies. But as always, we should be aware of the possibility of a bear market, but don't be driven by it, and recognize that we have really been through some terrible bear markets, terrible market declines in the last 20 years, and the market has always resolved itself and come back. So keep that in mind. The CNN Fear and Greed Index is at a moderate greed level, not extreme greed. We're well above the neutral level, where we've a month ago we were in extreme fear as the news about Omicron and the Delta variant were at the forefront. Now investors are back to putting money into the market. It was a good, strong end of the year. The market has opened up the year with some strength. It appears reaching all-time highs, so investors are not especially worried at this point. Here's where that index is over time. So you can see it vacillates quite a bit between extreme fear and extreme greed, all the way up and down. This CNN does this analysis where they look at 7 different indicators and calculate this value. So you can see on the far right where we are at around 70, high 60s on the index, and that's nowhere near the peaks that the Fear and Greed Index have reached, and it's been moving upward into greed and well above where it's been for most of the 2021 year. And just to remind you, Warren Buffett says it's always best to buy when the rest of the market is fearful, and sell when the rest of the market is greedy. And so we're in a greedy phase, but it's not. It could certainly get much greedier, which would be more of a warning sign, I think. So we keep it in mind, we keep it in the back of our heads, but we continue to focus on individual companies and not on the broader market. So let's talk about the impact of inflation on business. How will those higher costs impact the companies that you own in your portfolio? And well-managed businesses are always going to be able to integrate higher costs. They can manage inflation. How well they can adapt, how quickly they can adapt, rather, is a question. But smaller companies are a little more nimble in many cases. However, they don't always have the purchasing power in the marketplace. So it can, that offsets that ability to navigate. But well-managed businesses that are looking at the margin, that are planning ahead, that are hedging their energy costs if they're big consumers of fuel, that are always on the lookout for alternative sources of products and materials, especially in the commodity sector, they're always going to have that edge. And those higher margin businesses also often have pricing power. They can benefit from inflation because they can boost their prices a little bit faster. If they are a dominant player in their industry or have a unique niche, they can ramp up their pricing and offset the costs. They can manage pricing vis-a-vis competitors and also do well. So during inflationary times, growth companies with good profit margins are often the best bet. And that just comes back to our basic stock picking premise: is we're looking for well-managed businesses that are paying attention to margins, that have margins that are better than their peers. And I've said this before, but from my perspective, companies that have good profit margins vis-a-vis competitors, peers that have good trends. These are companies where management is really doing a great job at managing all the moving pieces of their business. They're managing labor costs, energy costs, occupancy costs. They're managing the cost of materials. They're managing their administrative costs. They're managing the costs of their capital. They're doing it all very well. And so it's a great gauge to look at. So for by and large, for the stocks that you would see in the Investor Advisory Service newsletter or the Small Cap Informer, inflation I don't think is going to be as much of a concern because we've already identified those companies that can handle prices that increase. They can integrate inflation into their business and still come out ahead. So I think that's a pretty good pretty good thing to keep in mind as you're looking at companies going forward. I did want to talk a little bit about some selected industry outlooks, and kind of point towards companies in our coverage universe that fit the bill. We're going to run through this kind of quickly, but again, the thinking is let's not be stuck with the old tropes, with the common wisdom, which often isn't very wise. Let's think about businesses and what are the unique features that could make individual companies perform. After all, we're not buying ETFs of these sectors. We're looking at inside the sectors, at the industries and companies therein, and trying to identify the best of the best. And if there's anything we've learned from the pandemic years of 2020 and 2021 is that there are always individual companies that have the right formula for success, that are able to thrive, and whose stock you can profit from when you purchase wisely. So let's talk first about the retail industry. Been up and down, but the retail apocalypse, the bricks and mortar apocalypse, just continues as e-commerce is gaining ground. Only 49% of Americans would choose to shop in brick and mortar. 67% of millennials prefer online shopping. Interestingly, Amazon is on track early this year to become the largest delivery service in the United States, and that includes, the post office and UPS and FedEx and the other players. Their fleet is enormous. Labor shortages are going to continue to pose problems on the retail side. If companies are not able to attract enough workers, that could impact them. And the supply chain, obviously, this is going to be a problem and remains a problem. If you've been to the grocery store in the last couple of months, it just seems fairly regularly you'll come across a section where shelves are just empty. There's just no products in a particular section, while the rest of the store is well stocked. Then you'll come back 2 weeks later, and that section is now filled up, but there's another section that's missing products. So that's going to continue to be an intermittent problem, and this is something that, in other countries around the world, they are not, their approach to commodities and groceries, for instance, much different than the United States. And it's, it's kind of a well-worn trope that visitors come to the U.S. and go to one of our common grocery stores and are amazed at the variety. They have, grocery stores in other countries have the same sorts of products. They just don't have 11 different varieties of ketchup. They've got one or maybe two varieties of ketchup. And so does that mean that maybe we'll start to see a little bit of a paring down as companies try to manage inventory a little bit better, instead of offering a little bit of everything, maybe try to accommodate. Those are philosophical shifts that we might expect to see as we go forward. I think that consumers still are looking for unique shopping experiences. They're still looking for instance, grocery stores and discount stores. I'm a big fan of those. Perform well during many stages of the economy. and I don't expect those kinds of companies to be uh, to be underperformers really at any point. Uh, in our small cap universe, we cover Boot Barn, Ollie's, and Five Below, and the thinking is that these are distinctive retail shopping experiences. They're not experiences that you can get shopping online. They're offering specific products or specific niches, and they're doing it quite well. Boot Barn and Five Below have been really strong performers coming out of the pandemic. Ollie's struggled on some of the supply chain issues, but in the small company retail sector, I think those are still remain viable opportunities for investors. On the restaurant side, this is really remains troubling for huge sectors of segments of restaurants. Sales across the industry look to have fallen around 24% in 2020, but they increased to about 20% in 2021. So we're getting back to normal, but delivery orders jumped from 7% to 20% in 2020. And now digital ordering is about 28% of all orders compared to 10% before the pandemic. And total traffic in restaurants is still below pre-pandemic levels. So people are not going out to eat as often. However, fast food is another issue, is another case. As opposed to sit down and the fast casual segment. Quick service fast food expanding, introducing drive-through. You see chains that are re-engineering their stores to have less seating capacity inside and having multiple drive-through lanes, for instance. Shake Shack opened its first drive-through in December, so they're expecting this to be more of a driver of business. With the restaurant industry, just as with the retail industry, the labor shortages and supply chain problems are going to remain concerns. And inflation is also a concern. Menu price inflation is at the highest point since 2008 already, and that's before the coming expected inflation going forward. And so by one analysis, after inflation, the 2022 total restaurant sales are expected to be about 92% of 2021 sales. So the impact of inflation is actually really going to cut into a lot of restaurant businesses. As I mentioned, the quick service, fast food, limited service, they're well positioned, but the full service and casual dining segments remain under pressure. The only restaurant that we cover right now in the small cap informer is Meritage Hospitality Group, which is a franchisor of Wendy's and beginning this year of Taco John's. So they're taking a West Coast taco restaurant chain and will be opening several hundred stores in the Michigan and beyond into the Northeast. And if you're not familiar with Taco John's, if you've heard of the phrase Taco Tuesday, that is trademarked by Taco John's. So in their markets, they perform quite well. So and the Wendy's chain stores have been performing quite well for this restaurateur as well. So we would expect, again, fast food is almost in recession proof. People, if they are feeling hard up and aren't willing to pay to sit down in a restaurant, they will still get takeout. They will still do the drive-through. They'll still eat at a fast food restaurant. And I think Wendy's has done a great job with some of its reformulation during last year. And Meritage has the numbers on how well their stores performed once they pivoted to accommodate the pandemic. Travel and leisure remains a difficult segment of the economy. Some experts in this area are suggesting that business travel and conferences may never fully return to where they were prior to the start of the pandemic. Total air passenger traffic is expected to continue to decline and be down about 3.6 billion passengers in 2022. And international travel had been projected to kind of come back, but now with the latest lockdowns, that's not likely to be the case. In the hotel industry, urban hotels are still reporting 30% below 2019 levels. And in New York City, hotels are not expecting to reach the pre-pandemic levels of occupancy until 2025, simply because people are not traveling. And when they are traveling, they're not traveling to large urban areas. They're not going into the city. So the industry has been adapting. I have stayed uh, went from pre-pandemic spending 75 to 100 nights a year on the road to spending 3 or 4 nights a year on the road. And the last couple of times that I've stayed in a hotel, there's no housekeeping in the middle of your stay unless you require it. Digital check-ins are becoming more prevalent. They're really looking to cut costs, but that industry still remains troubled. Amusement parks, again, are just not ramping up to accommodate large groups of people, and people are not standing in line for those. And cruise lines, with the recent CDC recommendation, all bets are off with when cruise lines might fully recover. I know some people who have traveled on cruise lines and felt very safe and secure and felt like the practices that were in place were very good, but it still doesn't mean that they're going to be anywhere near pre-pandemic levels for some time. On the upside, the recreational vehicle industry continues to go like gangbusters and is showing significant strength, lots of demand. Inventory remains limited, which is just ratcheting up demand. So that segment I would expect to continue to perform well through the 2022 year. In this area, we cover Air Lease, which is the airline leasing industry or leasing company, and they perform well during all sorts of periods of demand, low demand, recession, contraction throughout the economy. So even though airlines may not be flying as much, they still need to have planes, and it can be more economical for them to retire older planes and bring in new planes that are more fuel efficient, that have better amenities. So they and also during tough times, airlines might not be able to finance new planes, but they can lease them. And Air Lease has the order book. They've got the planes available to be leased from Airbus and Boeing that the airlines can't get directly. On the RV space, Winnebago and LCI Industries have done very well last year, and we would expect that to continue going forward. So, and there are other companies in the RV industry that I think are worth taking a look at. On the other hand, the automobile industry continues to look to be flat in 2021. The demand for used vehicles is very strong. On our investor advisory service, they cover a number of used car dealerships, especially the internet-enabled ones and auction services. Those seem to be a very interesting area, and as consumers are turning towards those opportunities to purchase used vehicles at a much higher premium than we've seen in quite some time. The big story on automobile manufacturing is the semiconductor supply chain. You might be surprised to learn that the average new car today has between 1,000 and 1,500 semiconductors. So any delays in those to manufacturers are going to slow production. The automotive industry consumes about 10% of all global semiconductors that are produced. So it's just a big drag on industry production. You can't get the chips, you can't get the cars out, you can't sell, you can't, et cetera, et cetera. Labor supply chain issues continue to remain concerns. We cover Allied Motion in the small cap informer. It's done terrifically well in the last year. They make motion control, so they are providing some of the components that are in demand and have been doing a good job in this particular segment. The real estate industry is hot and cold. Certain areas have done very well. REITs, real estate investment trusts, often serve as a hedge against inflation. They pay dividends. There's the chance of capital appreciation, but of course you've got to choose well. Commercial property sales really rebounded in 2021. In the first 10 months of the year, they were up 64% over 2020. So that is a strong sign that a lot of people are willing to invest in commercial properties, given all the uncertainty about how retail and how office buildings will be utilized going forward. Industrial and apartment building purchases were also up about 30% above 2019 levels. Prices were also up in 2021 in the third quarter, the most recent data there. But retail and office property sales remain pretty slow. Prices did recover a little bit. Cap rates are low. It's low interest rates, so when there's low interest rates, there's capital to be deployed. And that is enabling a lot of investors in real estate to make those purchases. Areas of interest in the real estate industry: senior living, skilled nursing facilities are below historical levels, but with the aging population in the US, it's only a matter of time before there is much increased demand for those types of facilities. Big winner in real estate in 2021 was self-storage. So the extra space storage that we've been covering for the last couple of years really performed quite well, and maybe the single most overvalued stock in our entire universe at this point. Even though you can sit and collect the dividend, the capital appreciation potential is not really there. Again, our theory is hold during overvaluation quality companies. And you probably are all familiar with what happens when you say, oh, this stock is overvalued, I need to dump it now. And as soon as you dump it, it goes up another 10 or 15%. But extra space storage has done very well. And DOC, Physicians Realty Trust, did not perform as well as we had hoped in 2021, but this is a operator of medical facilities, owner of medical facilities. So their rent base is pretty solid. They are located near major medical centers, so they don't have to worry about clients missing rent payments. Had very low rate of problems with rent collection as the pandemic began, and so we'd expect them to continue to perform well moving ahead. The construction industry, residential home building continues to perform quite well. Inventory is very low, especially for entry-level homes. Interest rates are low. Demand is high as people are looking to relocate, as they're not necessarily tied to a physical location. They're able to work remotely. If they're going to work from home, they want to have a nice office space that they can utilize. So lots of factors in the residential home building industry are favoring it, even as we go forward. PE ratios for many of these companies are super low because there's that nagging feeling that at some point everyone who wants a house is going to have one. But that could be some quarters off, to be sure. One of the problems, of course, is material shortages like lumber that have caused prices to go up, but that hasn't stopped consumers. So that has not been an impediment for the residential home builders. They're able to continue to drive their businesses forward. The private non-residential construction segment will probably start rebounding as the economic reopening continues to expand. People continue to remodel and rebuild. If we do get some federal infrastructure spending, that's going to support a lot of the construction industry as we go forward. It could really benefit the consultants and infrastructure plays like NV5 Global, McGrath Rents, Simpson Manufacturing, Eagle Materials. Those have all been doing really well going forward. NV5 was one of our top performing picks for 2021. We'll talk about them as well. On the home building side, we follow Century Communities, LGI Homes, and Cavco. And we also cover Essent, which is the PMI, private mortgage insurance provider, which is pretty much a mainstay. I think they've done well. By being a well-managed business, they have withstood the test of time, have lower rates of forfeiture than other PMI providers, and the low inventory means that even those mortgages that get defaulted on, the banks can turn them around without making a claim to SM. So they continue to be a strong performer. On the technology side, we talked a lot about the mega caps in the technology segment. Lots of profitability, lots of prospects for continued growth there. We would expect that to continue. As I mentioned, watch out for overloading on those. It's great to have the exposure, but don't overload on technology stocks. If you need to understand that better, go back to 2000, 2001, and look at what happened to technology stocks following the 1990s bull market. I would expect elevated IT spending and capital expenditures to continue in 2022. Companies are building out more robust networks. Certainly on the security side, there are increasing demands for companies to protect their networks from bad actors. So there are plenty of opportunities for improvement that's going to support IT contractors and consultants going forward. Hopefully the chip shortage should start to ease up later in the year. On the technology side, we cover a variety of both chip makers as well as service providers, companies like Universal Display, OLED, and Skyworks and Methode Electronics on the chip side, and DLH and Plus that we cover on the services side. Those companies, I've been a little disappointed by E Plus. Think it could have done a little bit better. Fundamentally seems to be pretty strong. But they are a very measured growth oriented company. But we would expect them to continue to benefit a little bit by companies taking a better look and closer look at their networks and expanding their work from home capacities and keeping their technology up to snuff. On the healthcare side, demand had been returning for elective procedures, but some of that has slowed a little bit with the lack of hospital space due to the Omicron variant and the increased hospitalization there. But again, I think every portfolio should include exposure to healthcare stocks. The long-term demographics, such as the aging of the population, really means that demand is always going to be there. A lot of biotechs and pharmaceuticals have a strong development pipeline, so we'll start to continue to see some releases there that will drive those companies. Labor shortages obviously are going to continue to be a concern within the industry that they're going to have to navigate. And Amazon is announced they're looking to get into the healthcare business with Amazon Care, which is a hybrid telehealth in-person healthcare offering. Amazon has disrupted a number of different industries, so it will be interesting to see how they fare in the healthcare industry now. On the stock side, we cover Charles River Associates, AMN, and AFIA. And we'll talk about AFIA later on, but AMN and on the healthcare staffing side, and Charles River on the biotech pharmaceutical testing side, I think are interesting companies to take a look at. And then finally, we'll wrap up with financial services. The thing to remember about inflation is that as it goes up and as interest rates increase, it will actually help a lot of financial service companies, especially regional banks that are profitable. If they've been profitable in a low interest rate environment, if rates start to go up a little bit, their margins can expand faster than the rates go up, so that increases their profitability. Likewise, home insurance premiums have been rising, have been increased. Part of the problem is that for home insurance, if you've renewed your policy recently, you might have gotten a little surprise. As home prices go up and as costs of materials go up, the replacement cost for your home goes up, which means your premium needs to go up. Climate change is also an issue. The number of disasters that we've had in many places, ranging from fires and snowstorms, tornadoes, or hurricanes, etc., is putting pressure on a lot of home homeowner insurance providers to raise their rates. So I think there's actually opportunities there for investors. We'll be taking a look at this segment to see if we can find some reasonably priced companies there. But that could be some place to consider if you really are thinking that inflation is going to kick in and be an issue for the foreseeable future. On the stock side, we cover South State Bank. And one of our newest companies is Glacier Bancorp, which is in a very attractive region of the United States and could benefit from this. And I'll mention Essent once again on the PMI side. And just for your entertainment, I did look at the outlook for the weather across the United States from the Farmer's Almanac, and they say it's going to be a season of flip-flop conditions with notable polar coaster swings in temperatures. So, many areas of the country, it's just going to be a typical miserable, icy, wet, cold mess, but some of the other places down south might be a little bit colder than they had expected. So if all else fails, remember gold is a hedge, and gold mining stocks are someplace that you might take a look at. Right now, I still am a fan of Franco-Nevada. It's a royalty gold miner, so it's not analyzed quite as easily as an operating company on the stock selection guide, but I think they give you a good dividend, and they are investing in the best gold miners around the world. So they do the work, you can benefit in your personal portfolio. So let me take a break and take a look at some of the questions that have come in here. Bob asks if we've taken a look at Medical Properties Trust, which is another real estate investment trust in the medical properties area. And yes, I have taken a look at them. Timing-wise, we went with Physicians Realty Trust because at the time they were more reasonably priced. But I like Medical Properties Trust as a company. Tim asks about the comment about the 30 largest stocks in the market. Yes, so we're talking about the S&P 500, where the 30 largest stocks in the S&P 500 are responsible for, something like half of the value of the S&P 500. So that doesn't include small caps, but where mega caps go, the rest of the market tends to follow as you go through there. Neil asks about the performance results, the 34.2%. Was that based on all stocks during the year, all stocks added and removed? And yes, the performance results that you can see, the graph on the SmallCap Informer website, are based on investing an equal amount in every stock as it's released, and then benchmarking that to the selected index. So the idea is we're not a quote portfolio of 50 stocks, but this performance figure captures the rate of return, the annualized rate of return of the aggregate of all stocks that are covered in the newsletter. So, and the fact that it's benchmarked to the small cap index means it's an apples to apples comparison there. So we're not taking out any stocks. We're counting the underperformers, the outperformers, the stocks that are sold, and the stocks that are added. So it really does measure the entire performance of all of the picks as if they were in a single portfolio.
Doug,
yes.
So that means it's essentially like the valuation statement returns for a portfolio. If you're using the accounting, it uses internal rate of return and when you purchased or sold the stock.
Yes, thanks, Russell. That's absolutely the case. So
I had one other question to add this.
Yes.
When you're saying you're making equal purchases for all of the recommendations, is that an equal dollar purchase or equal share purchase?
Yes, that would be an equal dollar amount that we consider. So I run a model portfolio essentially, where I track every purchase and every dividend, every gain, every purchase, every sale, every dividend, every stock split, et cetera. And so we assume an equal investment in every stock that's selected. And so that's the upshot of it. We're using, this is an industry standard calculation that we're using. And the idea is that, as I said, we're not suggesting that this is the return that you are likely to receive, but with a well-selected grouping of stocks, this is an average return that would not be out of the question that you could earn from the picks that you follow. So
Okay,
hopefully
and
that's clear. Yeah, go
I
ahead.
just want to add, in the forums on the SCI website, there is a discussion of this too, so people can go and look at that.
Great. Thank you, Russell. Let's go ahead and a couple of other questions, but we'll talk about some of these as we go further. I'll hit on some of these other topics. So let's talk about, I wanted to mention we have a little new feature on the SmallCap Informer website, which is a recent price change report. The idea is this shows the price change as of the most recent close compared to when the issue was published, and also we'll show you the daily price change for the most recent day. So this is going to fuel some of our the functionality that we're building out to alert subscribers of significant swings in prices, either positive or negative, that might alert you to take a look at some of the fundamental, something that might be going on fundamentally with the stock, and also a way of kind of seeing stocks that are on your radar, that you say, well, gosh, if this stock was $5 cheaper, I would be a lot more interested in it. This is a tool that would help you to kind of see those types of alerts. So at this point, if you go to the subscribers area in the left-hand navigation, you'll see all of the stocks, the last closing price, the price in the last issue, the percentage change since the last issue, and then the daily price change from the current day to the most recent day. So we always use closing prices. So in this example here, Allied Motion was up about 17.5% from the last issue, which is pretty strong. But on the day in question, they actually gained 12% in the day. So we're working towards sending out email alerts when stocks move more than 10% in either direction in a single day. That's the premise that we're starting from. So this is again part of the website features there. You can kind of check in, bookmark that page, check back, and see what are some of the biggest movers, the biggest gainers, biggest decliners, as they say in the industry. And we'll see for more information as we go forward on how we deploy that. So let's talk about our top small cap stocks for 2021. So we've been doing this for the last couple of years, where we put out a special report with 10 companies that we pull out as having attributes that we think are going to make those companies especially interesting in the year ahead. We provide it to subscribers at the beginning of the year. So for 2021, our picks were only up 14% on average, including dividends. The S&P Small Cap 600 was up 26.8%. And so as you can see here, 7 out of the 10 stocks actually were in positive territory. 3 of the 10 declined. We had one big winner, NV5 Global, almost doubled in price. Methode Electronic was also up above the average of the broader market. We've got 5 stocks that were up between 7 and 22%, and then the 3 losers. And Kirkland Lake Gold we discontinued in December, pending its acquisition. Of these, 4 of the stocks were defensive, which would have been our gold miners, a discount store, our REIT. Those we really see as more defensive than and a position to take in times of uncertainty. And again, going back to where we were at the beginning of 2021, I think we can be forgiven for wanting to be safe rather than sorry. And if you think about it, in most years, a 14% rate of return is pretty solid. Nothing to sneeze at when you compare it to the broader market return. So not entirely dissatisfied with the picks, given that pivot that we made and that particular decision to be safe rather than sorry, and not go with some of the more aggressive, bigger picks. As we go through these, we kind of can talk through the gold miners, the royalty gold, Kirkland Lake and Franco, Nevada. We're there for defensive purposes. Physicians Realty as a medical REIT was there, collect the dividend, and get a little bit of a capital appreciation. And we didn't expect that they would be having particular problems being the business that they're in. Ollie's really dissatisfied with that performance. Again, they had been performing well through much of the year, but then ran into some supply chain issues. But the discount store business is a place where you want to be during economic hard times. So that particular one didn't work out. And the others were, Medifast had, again, performing very well in the fitness area, but that level of growth is not able to be sustained. So as the growth kind of slowed down, investors soured on the business a little bit. Essent, again, I think there's still some value to be unlocked with Essent Group as the private mortgage insurer. The doom and gloom scenarios have not come to pass and don't look to be coming to pass, but the stock is still held back a little bit. So we expected NV5 and McGrath RentCorp to perform well as infrastructure spending might kick in a little bit, and certainly that was the case for NV5. McGrath RentCorp a little bit behind, but still pretty solid there. So all in all, not the best year, not the worst year. And given other economic hard times, I think there was a case to be made for many of those companies there. But that leads us to the 2022 special report, the top small cap stocks. Again, this is an interesting exercise, I think, to pull out those 10 stocks from our coverage list that are perhaps worth another look. So often they are stocks that we've covered more recently. Again, it's the top small caps for 2022, but we're really looking at that 5 to 10 year horizon. And this year, I broke the list into two groups. One is a more traditional, high quality growth stock list, and another is what I'm calling deep value growth stocks, stocks that have been beaten down, that have where mathematically they just seem to make a whole lot of sense, but they're small. The market doesn't have a lot of confidence. It will take a little bit of a catalyst to get them going, but I think the potential is there for some significant returns. So, but they definitely are more speculative as a result of it. So it'll be interesting in a year from now to see where we stand with these stocks. On the top stocks list, I think that Skyworks has been performing well for us. It's one of our best performing stocks since we started covering it. It's a little large for the small cap definition, but we're not going to kick them out of the club just because they've done well. But I think that they have, better than many other companies, have a good grasp on production, on research and development, on managing costs, and on being out in front of what the rest of the industry is looking for with their chip solutions. So I think that they are a good stalwart. I mentioned RB Industries. I like LCI Industries. Very affordable right now, given the growth that we're likely to see from this company going forward. They just keep making the parts that go into RVs, and the average amount of parts that go into RVs made by other companies that come from LCI are very strong. So there's a lot of demand there. As the demand is strong for new RVs. That puts pressure on older RV owners who can't upgrade their units like they might have in the past. So they might be looking to upgrade components. And so that aftermarket business plays into LCI's hands. I like Intermex, which is a money transfer check cashing service. They have a big business outside the US in Latin America, Mexico, South America, but they are in Africa as well as Europe and the United States. This is a business that serves populations that don't have access to traditional banking with services that include payroll, debit cards, and check cashing services, money transfers, especially from country to country. It's just a great technology enabled business. They've got an app, they've got a website, so they've got to me, it's a fintech play with a physical presence, which is a big bonus. It's not a brand name here in the U.S., except perhaps out in the Southwest, American Southwest, and California. But I think they have a lot of growth opportunities going forward. This year, it's going to be they're going to close out 2021 with their fourth quarter results, where sales and revenues and earnings are going to be, upwards of 25%. To pay 16 PE or 14 PE for that is a pretty good bargain. Universal Display makes the OLED chips, and this is the screens. These are the screens that are increasingly being utilized in cell phones and mobile devices and tablets and televisions. It is the technology of the future. It's there today, and so I wouldn't write them off. I think that's a great opportunity, and the PE is high, but this is at a more reasonable level than they have been selling at in the last few years. And then finally, Glacier Bank Corp, which I mentioned, is a hybrid community bank, regional bank. They operate 17 different bank brands. And so those brands continue to maintain their community affiliations, but they have the heft of a larger holding company behind them. So very innovative, I think, out in the Rocky Mountain region, obviously Glacier, Idaho, Nevada, Utah, but there's a lot of economic growth opportunity there. So we think that they've got all of the pieces to put together a good future for investors headed out from there. And on the deep value list, these are some underperformers, but the numbers just seem to add up. You can see the PEs of a couple of these are in the single digits. Gravity is an electronic gaming company, primarily outside the US, but that's an enormous market in Asia, China, Singapore, Malaysia, Korea, where they're from, Japan. And they do have products that they release into the US. Their release cycle, when they've got new gaming consoles that come out, that can drive it, but they're also a mobile app creator, and that is a growing area within computer gaming. More risky, obviously, but I think there's a lot of growth prospects there. Corsair Gaming makes hardware for the gaming business, professional gamers, amateur gamers, as well as podcasting and webcasting equipment, lights, cameras, microphones, etc. A lot of evolution of the computer gaming market kind of is coming together to drive Corsair, and I think they've got a lot of room to continue to grow. When you compare them to someone like Logitech, a more established provider, you'll see Corsair is expanding their margins. They're establishing a product lineup that commands a premium, and that's going to continue, I think, to be the case. Again, supply chain, chip shortages impacting their business, which I think is an entry level, provides an entry opportunity. Superior Group, and I see that Chris asked in the questions about Superior Group. Yes, Superior Group, they're on my list. This is, again, you look at the numbers. Yes, they're not going to be growing at 20 or 25%, this year. But even at 12% to buy them for a PE of under 10 just seems to be a good bargain. They are expanding their businesses in the call centers, in the promotional product line, in the apparel business. They're releasing new wearable apparel for the medical segment, washable, wash and wear kind of apparel, and that's been gotten a big release. One of their competitors is Cintas, which is the big the big provider of business uniforms, but Cintas is a customer of Superior Group. So I think that they obviously they had a great year selling personal protective equipment, masks with company logos on them, hand sanitizer bottles that were branded, etc. And a lot of that business is not going to go away, but I think they've made inroads into a lot of companies that are going to enable them to build going forward. And they've been in this channel now for a year. Where the price has just been stagnant, even though results keep coming in, earnings keep coming in. So again, I'm cautiously optimistic about Superior Group. Educational Development is another pandemic story. They did very well. It's a publisher of children's books primarily. They had in the past relied on school book fairs as a channel to sell, as well as home and independent salespeople. In the stay-at-home moms, for instance, and so that business did a big leap in 2020 as parents were stuck at home looking for activities for their kids. If they could encourage their kids to spend part of the day reading with new books, that would work to everyone's benefit. Obviously, a lot of those sales are not going to recur after the pandemic. They are due to release their earnings tomorrow, and then we'll know the story. But I'm very optimistic that I think the company can continue to build on what it's been doing, and we're just looking at a pretty nominal growth rate, and so I think they qualify for this list as well. And then finally, AFIA, kind of complicated because it's a Brazilian business operating almost exclusively in Brazil, making tools for medical practitioners that support their education, as well as operating private medical colleges and schools. But they train practitioners across everything from physical therapists up to physicians. But one of their great business advantage is that they make study aids and tools and diagnostic guides, etc., that students utilize, and then as they become licensed professionals, they continue to use those tools. So they have once they introduce people into their ecosystem, they've got them for life. Brazil is an enormous country. Lots of people live there. The demand for medical care is very high. There are so many fewer doctors than in countries like England or the United States per capita. There's a lot of demand. It's a great job to have, to be working in the medical industry there. So there are a lot of tailwinds that I think are going to continue to help AFIA. It takes a little bit more work to translate their results from the Brazilian real into dollars, but if you just look at the fundamentals, I think they're pretty strong. Some concerns about debt. But again, they just generate a lot of cash flow and have been making a lot of acquisitions, and I think that is going to benefit them down the road. So those are my picks. Let me know what you think. Always looking for feedback. You can download the full write-ups for all of these companies in the special report on the SmallCap Informer website, or there in the handouts tab. Let me just take some time and take a look at some questions there. Sharon asked, when will this video be available to rewatch in the next day or so? We'll get it there. These are the Bonnie asks, are these stocks being discussed as potential studies for purchase this year. Yes, the idea is these are stocks that we purchase. There's a bias that individuals often have that once you've made a decision to buy a stock or not buy a stock, you don't revisit that decision, even though circumstances may have changed. So part of my objective with this report is to say, here are some of these great ideas that we've covered. Let's go back and revisit them and to take a little more particular look. In a month or two, we're going to release this report to the general public, so subscribers get early access to it as a bonus, as a benefit for subscribing. There is an advantage if you think that again, we as subscribers are not a big enough block to really affect any of these companies, but you do get to say, I learned about it first, which is pretty good there.
Ted?
Yes, go ahead, Russell.
Sharon's question also about the video is where it will be available, not just when.
Oh, where? On the SmallCap Informer website in the subscriber area, you will see we've got the links to the previous webinars, and we'll release it there. We'll release it. This is a subscriber exclusive, so for the next month, only subscribers will have access to it. Then we'll likely at some point release some version of it. We may excerpt a little bit of it on our YouTube channel, which you can find on YouTube if you search for SmallCap Informer. But on the SmallCap Informer website, we will have it available there, certainly in the next couple of days, so you can take another look at it at that point. All right, I think with that, a lot of questions. We'll take a look at those questions as we go forward, but I know we went a little long. There's a lot to cover. Boy, there's so much going on in the market and the economy, and I did want to spend a little bit of time explaining the 2022 picks in a little more detail. Once again, thanks to all of you for attending our presentation and for being subscribers, being part of this effort to identify smaller companies for your portfolios using the time-tested principles of better investing. In August, we'll hit our 10th birthday, so we're glad that you've been a part of it. Thank you to Russell in the back office for helping, and we will look forward to seeing you at our next subscriber event. We'll be planning a mid-year webinar in June or July where we'll look at where things stand, and hopefully we'll have more good news to report about the markets and the performance of the SmallCap Informer stock picks. Until then, stay the course. I'm Doug Gerlach. We'll see you next time.